Diversification is an incredibly important thing to get right when it comes to investing. However, just how much diversification is really needed? If you were to invest half of your money into a total US stock market index fund and a total US bond market index fund, would you be truly diversified? What if you threw in some real estate, commodities, or precious metals into the mix? Would you be diversified then? Or is there a benefit to going all out and diversifying yourself across the whole world? That's what we're going to be discussing today as we look at the global market portfolio, which splits up our investments across stocks, bonds, real estate, and other hard assets both domestically and beyond, in order to create a truly diversified investing strategy by just about any definition. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So I do need to get some caveats out of the way here first. Namely that when I say we're looking at a global market portfolio, I mean that literally. We are looking at a global market portfolio, not the global market portfolio. Because the global market portfolio in most financial studies is made up of a lot of different types of investments that I don't have data on. And honestly, many regular investors don't have access to. The portfolio is usually a dynamic allocation as well, meaning that the percentages of your money that you put into each asset changes as time goes along, in line with how much of the value of the global market is represented by that asset. The spreadsheet that I've been using for this series was not originally built for that. It was built for the purposes of general study, so that I could get an idea of how various asset allocations compared to one another across various time periods, and when using various financial techniques to try and improve specific metrics. Therefore, I'm going to be using a static allocation that, to the best of my ability, averages out the weightings for each of the asset classes that I have actual data on to give us a general idea of how a global market portfolio would have performed historically. The last caveat that I want to make before we get into the actual allocation is that some countries don't have quite as much publicly available data as the United States does on many of their assets. As such, I only currently have data on things like global bonds going back to 1985 or so. And as global bonds take up a good portion of this allocation, I don't feel comfortable trying to estimate returns for the portfolio any further back than that, which unfortunately means that some of the metrics today, such as long-term returns, risk-adjusted returns, standard deviations, and downside deviations, to name but a few, are not going to be truly cross-comparable with the other strategies we've looked at so far in this series. But with that out of the way, the allocation we're going to be examining today has you split your investments up into 4 different categories: worldwide stocks, worldwide bonds, commodities, which I'm actually going to be representing with gold as I have more data on it, and as most of the studies I've looked at use commodities that are very heavily tilted towards gold, often with nearly 90% of the commodity fund being made up of gold, and lastly, real estate. The specific weightings are worldwide stocks at 50%, worldwide bonds at 44%, real estate at 4%, and gold at 2%. As usual, we'll start by analyzing the strategy's historical returns. To analyze the returns, we'll be looking at several different metrics: the short and long-term inflation-adjusted returns for every starting year for which I have available data on all of the assets in this allocation, in this case since 1985, the risk-adjusted returns, how often the portfolio loses money on an inflation-adjusted basis and how severe those losses were, and of course how dependable the strategy is based on how sensitive those long-term returns are to when you decide to start investing. So based on the data I have since 1985, the average 10-year inflation-adjusted return for the global market portfolio is about 6.1% per year. Its best and worst 10-year stretch saw annualized returns of 10.4% and 3% respectively. That suggests that a $10,000 investment would grow to, on average, $18,000 over the course of 10 years after adjusting for inflation. At worst, you're looking at a nest egg of around $13,400 and at best, $26,900. In any given year, the returns have been as high as 26% or as low as negative 20%. On average, they've hovered around 6.5%. The Sharpe and Sortino ratios for this strategy were 0.53 and 1.5 respectively. The average 10-year standard deviation of returns for the global market approach was 9.7%, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 3.6% and 15.8% with this strategy. The strategy had an excess kurtosis value of negative 2.77, suggesting that the majority of its returns were within a few standard deviations of our average. It also had a skewness of negative 0.76, suggesting that the majority of its returns would be above the long-term average. As far as losses go, there were a total of 11 years, out of a possible 37 in this case, where the portfolio failed to keep pace with inflation. That's a loss frequency of around 30%. Of those losses, 2 fell by at least 10% and just 1 by at least 20%. Thankfully, most of those downturns were recovered from relatively quickly, as there wasn't a single 10-year stretch where the strategy failed to keep pace with inflation. The 10-year stretch that ended in early 2009 was the closest to trailing inflation, but it still managed to grow by 1.6% per year after the adjustment. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance, as low as possible. The global market portfolio had a total start date sensitivity of 8.7% during this time frame, with an average start date sensitivity of 2.3%. That about wraps up our analysis of the strategy's returns. Now, let's move on to a crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, that you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at several different metrics when analyzing the crashes. They are the depth of the crashes, how long it took for the portfolio to bottom out, how much the strategy rose and fell relative to the rest of the market, how much of its time was spent in either crash or correction territory, how strong and sustainable its rebounds were when they came, how long it took for the strategy to set new all-time highs, and the ULSR index, which seeks to give investors a better idea of what the investing experience will be like by considering the depth and duration of downturns. For the global market portfolio, the deepest inflation-adjusted crash took place during the Great Recession of the late 2000s, when it trailed inflation by just over 20%. However, the longest downturn was actually the dot-com crash of the early 2000s, which took a full extra year to recover from, even though it only trailed inflation by 16% at its worst. The average downturn saw the global market portfolio fall 7.8% from previous highs, with a downside deviation of 5.7%, suggesting that the majority of downturns would see drops between 2.1% and 13.5% once they eventually bottomed out, which is pretty darn good in terms of tranquility. But the data is only going back to the mid-1980s, so it is difficult to get a full picture. On average, it takes around 3 months for the portfolio to bottom out. This gives it a dive rate, or the amount the portfolio would fall in an average downturn if it continued to fall at the same rate for a full year, of 31%. In the year immediately after bottoming out, the global market portfolio had minimum, average, and maximum rebound intensities of 4%, 13.9%, and 18.9%. If we filter those results to only look at how it bounced back following major market crashes, we get only one result, which is a 17.5% rebound following the depths of the Great Recession. To get an idea of its longer-term resiliency, we can look at what I call the portfolio's comeback magnitude, which measures how much the portfolio grows each year on average between bottoming out and setting new all-time highs. In this case, the global market portfolio's comeback magnitude was 7.5%. On average, it took a little over a year for the global market portfolio to set new highs after bottoming out. That means that on average, downturns lasted roughly 16.5 months for this strategy. It spent roughly 8% of its time in correction territory and just 3% of its time in crash territory. And its downside capture ratio, which measures how far the portfolio falls relative to a benchmark in the months that the portfolio itself is falling, was 81% when measured against the US total stock market, suggesting that when the portfolio does fall, it does so by less than the market as a whole. On the downside, when the portfolio was rising, it was doing so at a slower rate than the overall market, scoring an upside capture ratio of just 36%. This makes its overall capture ratio 45, suggesting that its strong downside protection was not quite enough to make up for its lackluster upside potential relative to something like the overall US stock market. Finally, the ULSR index rose to as high as 0.6 during these years, and on average hovered around 0.2, both of which are very strong. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the global market strategy would have maintained minimum 30-year safe withdrawal rates of 5.99% during this time period. The worst year to retire using this strategy during these years was 1991, and somewhat alarmingly, the safe withdrawal rate dropped in almost every single one of the available years. A 1985 retirement start date would have allowed initial withdrawals of 8.13%, which jumped up to 8.78% in a 1986 start, but after that, the withdrawal rate fell in every successive year, all the way down to the 5.99% we saw in 1991. So we'll have to see if that trend reverses itself in the future. And I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The strategy would have maintained a minimum perpetual withdrawal rate of 4.7%, And as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original inflation-adjusted principal all the way through to the end of the dataset. In terms of income during financial independence, the global market portfolio generated an average of roughly $114,400 per year on a $1 million nest egg among all the available 30-year cycles. The median income was a bit below that at around $113,100. Over the first 5 years of FI, those figures clocked in at around $78,000 a year each, with income rising in roughly 97% of all years. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming that we save 15% of our income, we're planning for a 30-year retirement, and our expenses changed in line with inflation, as measured by the CPI, we would not actually have yet achieved financial independence. However, with a 30% savings rate, we would have reached our goal in 7 of the 37 scenarios. On average, it took about 32 years to reach FI, with the fastest being 30 years and the slowest being 33 years. With a 50% savings rate, a hypothetical investor would have reached financial independence in 24 of the 37 scenarios, on average taking about 14.5 years to do so, with the fastest being 13 years and the slowest being 16. And finally, with an absolutely crazy 70% savings rate, the numbers improve still further, with a hypothetical investor reaching FI in 31 of the 37 scenarios, taking on average anywhere from 5 to 7 years to do so. So with that being said, what do we have here? Well, we've got a pretty consistent, not very luck-based allocation that doesn't crash too severely or for too long, even during major market turmoil, as we would expect given that it's not too stock-heavy and is broadly diversified. What that leads to is a very reliable journey to financial independence. You may have noticed that I didn't mention which starting years the fastest and slowest accumulation paths occurred in during that last section. The reason for that is because there would have been way too many of them to mention. Over the course of nearly 40 years, the best and worst outcomes were never separated by more than a few years, even at the 30% savings rate, where the variability and sequence of returns plays a larger role in determining the time it takes to reach financial independence. I know we aren't covering quite as big of a time span as we usually do in this series today, but that's still pretty darn good. Now, you could alter this allocation a bit to fine-tune it for more growth, which, admittedly at over 6% per year isn't horrible, but still, or optimizing for some other metric, or you could do what most studies have done with this idea and alter your allocation every quarter or every year to match the ever-changing global marketplace, and that would alter some of these metrics, but it likely wouldn't change what may be the biggest benefit of utilizing a broadly diversified strategy such as a global market portfolio, which is that very predictable path to financial independence. Now, whether that's salient enough of a benefit to act on is, of course, totally up to each individual investor. For me, as a young guy with a long time before I plan to use any in my investment money, I'd probably choose an allocation that's a little more fine-tuned for long-term growth. I wouldn't want to completely shelve the predictability and long-term protective aspects that comes with a more consistent, dependable, and tranquil allocation that isn't putting all of its eggs in the basket of one or a few countries, but I probably would at least fine-tune it a bit. But that's just me. What do you think of a global market portfolio, and the merits of an allocation that decreases the range of possible time it takes to reach FI? Is having a better worst-case scenario at the expense of a slightly worse best-case scenario worth it for you? Why or why not? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.